So you'll be pleased to know we finally reached the last problem in this chapter. It's a bit long, so bear with me. So what we're told here in the required for number 1 is to prepare the budgeted balance sheet as of April 30th, and we're asked to show separate computations for cash, for inventory, and owner's equity. And so now I'll go and show you each of these schedules and how the information was derived. So for cash, what you're basically doing is you're going to look down through and see which items affected cash. So your beginning balance is $40,600. Your sales, you had sales of $90,000. So as typical with most companies, some people pay cash and others will have an account set up with the company where they will make payments at a later date. So 70% of it was cash immediately upon purchase. So you got 70% times 90,000 will give you 63,000. The remaining part is on collections. So for collections, what you're going to be doing is, of the 90,000, 30% of that is on credit, and you're going to collect half of that in the month of April, and the remaining half you're going to collect in the month of May. The other piece that's factored into collections, and this is coming from number I in the problem, is that in the month of April you are told that you collected $29,700 for 50% of the March sales, which you then collected in April. So collections are impacted by the current month and the previous month. So the total is $43,200. The next thing that you're factoring in here is looking down through the list of accounts that would impact cash is payment of liabilities, and that's in J. You're told you paid $17,300 for payment of March 31st liabilities. So in the next line item, L, is your cash purchases. So you were told that in April you purchased inventory of which $10,000 was for cash. So that's where the $10,000 is coming from. Then in terms of what you purchased, so you purchased $10,000 of your inventory with cash, and the rest you put on credit. So of the $36,000 you put on credit, you only paid for half of that in April, and the remaining half you're going to pay for in May. So that's why it's 50% times $36,800, $18,400. Purchase of equipment, that's in number B, and that's your capital expenditures of $42,800. Operating expenses, that is coming from section E, and here you're told that it's going to be, your operating expenses is based on your total expenses is $13,200, but 25% of that will be paid by cash in the current month. So 25% times 13,200, 3,300. So your ending balance in cash is $55,000. So it doesn't matter what order you put this in. If you just want to go down through sequentially and look for which items affect cash, as long as you're including all of the items that are either increasing or decreasing cash, that's all that matters. So your ending balance for cash is $55,000. So the next schedule that we have to complete is inventory. So inventory, again, it's always going to be factored as looking at your beginning inventory. What you purchased less what you sold will equal what you ended with. So your beginning inventory, that's from K. You're told what your balance is. Your purchases of inventory, the total purchases is $46,800, and here we're not concerned in inventory as to how you paid for it. So we know that $10,000 was purchased as cash and $36,800 was purchased on account. So the bottom line is you actually bought $46,800 worth of inventory. But when you're counting inventory, how you paid for that inventory is irrelevant. So how much of that did you use during the year? While your cost of goods sold is from Part D, and you're told that your cost of goods sold is equal to 60% of sales. So 60% of 90,000 is 54. So you started off with 29,600, you bought 46,800, you sold $54,000 worth. So that means your ending inventory balance is 22,400. Now the final schedule that we have to complete here is your owner's equity. So with your owner's equity, you have your sales revenue less your cost of goods sold is going to give you your gross profit. Then you have to deduct your operating expenses. So you have your depreciation, which comes from Part C, and other expenses, Part E. So deduct that, comes down to $21,900 is your net income. So it's the net income that's going to increase your owner's equity. So you add that net income for the month of April to your beginning owner's equity balance of $93,700 to come up with your ending owner's equity of $115,600. So that's where the numbers are coming from in each of the three schedules. So now we take the information that we calculated here and we bring this back to our balance sheet. So we see our $55,000 for our cash, accounts receivable, what you sold. You recall that of your sales, 70% was for cash and the remaining 30% was purchased on account. So people who bought that stuff will pay for it later in the month and the following month. So half of the $27,000 you're going to be owed at the end of the month. So that's where the $13,500 came from. So your current assets is comprised of the three categories: cash, accounts receivable, and inventory, and added together for your $90,900. Your assets, you started off with, in A, your beginning balance of equipment is $52,400, plus you purchased $42,800 during the year, which will give you $95,200. The next thing you have to factor in here is your accumulated depreciation. So that comes from B and C. $41,000 is your beginning, plus depreciation during the year will give you total accumulated depreciation of $42,200, which of course you have to subtract that from the value of the assets. So the total assets, your accumulated depreciation, your assets less accumulated depreciation is $53,000. So your total current assets is $143,900. The next section of our balance sheet is, of course, our liability section, and here you have to record your accounts payable. So you'll recall that of the purchases that you bought on credit, you are paying for half of that this month and half next month. So that's where the 50% is coming from, $36,800. So you paid for half, and you now owe the other half that will be paid for in the following month. Accrued expenses payable, and so this is coming from Part E, and you have your operating expenses of $13,200. So you're told that 25% of that is paid for in cash, which means you owe for the remaining 75%. So that's where that 75% is coming from, because you're told you paid 25% of it in cash, so you owe the remaining 75%. So your total liabilities would be your accounts payable plus your accruals, $28,300. Finally, The owner's equity, we just calculated that, and that came from the schedule, 115,600. And of course, your balance sheet must balance. So if you've done this correctly, your totals here for your liabilities and owner's equity must equal the 143,900 for your assets. So that's an overview of how we come up with our balance sheet. So the next requirement is prepare the combined cash budget for the month of April. So here you're just adding everything together. So we'll just scroll down here. So you start, all you're doing here is really providing a summary of how we got to the cash at the end of the period. So we start off with 40,600. Cash collections, what you collected for prior period sales plus what you collected for current month sales, your 63,000, your 43,200, 106,000 total cash available. It's 146,000. Now we want to identify the cash that we actually spent during the period. And so for inventory purchases, we see here, we're just bringing these amounts in from the schedule. So 17,000 comes from I, 10,000 from section L, and then 50% of your 36,800. So that comes you to your 45,700. Operating expenses, so that's the cash portion that you're paying for in this month is your 3,300. And your equipment purchases, part B, you're paying for all of that in cash, 42,800. So again, this is another way to look at your cash to prove that your calculations are in fact correct. So that's your cash budget. So part 3 is presenting the scenario with, suppose Alliance Printing has become more efficient and become aware of more efficient and more expensive equipment. What is the total amount of cash available for equipment purchases in April if the minimum desired ending cash balance is 21,000? So here for part 3, what we're looking at is our budgeted cash balance is 55,000, but now they're saying your minimum required cash, the minimum they want, is 21,000. So what this means is you now have some additional cash available to purchase the equipment. So you've got 34,000 available, plus you're no longer going to be budgeting for the 42,800 that you're told that to ignore that for the budget equipment purchases. So you add that in here, so now you've got a total of 76,800 available to purchase some new equipment. So with the next scenario, part 4, it's basically a replication of what we just did. The idea here with part 4 is you're just assuming that your sales, instead of your sales being 90,000, they're only going to be 60,000. So you would basically go through all of the schedules and change all of the numbers. So you see here, your cost of goods sold is based on 60,000, cash sales, everything is based on 60,000 instead of 90,000. So this is self-explanatory. If you understand the first scenario we went through, it's only basically go into the schedules and change your 90,000 to 60,000. So I'll leave that for you to review on your own. As well, part C of 4 is again something you can read on your own. It's about sensitivity analysis, so again this is pretty much self-explanatory, so I will leave that for you to read. So when I say things are left there for you to read on your own, don't take that as to mean that it's not important and that it's not going to be tested. It's just something that there's not a lot of value to be added from my walking you through a debrief of that particular problem. So that concludes 9-64.